Greetings, friends. With the ever-growing interest from traders in prop firms lately, I've been getting more and more specific requests to do reviews, share my own personal first-hand experience, or give my honest opinion on various prop firms. So I decided to start off with this video. Unfortunately, this video is more of a negative review, but nevertheless, a negative experience is still a valid experience, and it's always useful to have. From the moment a trader buys an account from a prop firm, a certain, shall we say, conflict of interest arises. What does this actually consist of? The trader, on their part, naturally tries to generate a steady profit and receive those earnings as a formal payout, which the prop firm is then legally and contractually obligated to make to the individual. The prop firm, in turn, which generates its revenue by selling accounts, tries to do its absolute best to avoid making those payouts to protect their own profit margins. Some prop firms rely solely on specific rules and stringent conditions they create to make the trader's challenging task as difficult as possible. A number of these proprietary trading firms start making up all these restrictive rules and specific conditions on the fly, so to speak, and then proceed to immediately accuse the trader of violating these newly created terms. And naturally, they categorically refuse to issue the payout and permanently close all associated trading accounts. And here, for the individual trader, the likelihood of successfully withdrawing funds depends essentially on the company's overall integrity and its ethical ability to strictly stick to its own established rules, meaning they must do everything exactly as it is written in the contract. And now, in this specific situation, we are going to talk in detail about a negative experience with the prop firm known as instantfunding.io. This is essentially their website. Right here at the very top of the screen, we can see an honest warning clearly stating that trading is not done with real money, and naturally it is only on demo accounts. Further down here, we see various perks and benefits. You can see this for yourself. Actually, I'm not advertising anything here. I am just showing you how it works. And it is a pretty good, I would say, diverse selection of accounts, both in terms of their balances. And as we can see, these are already funded accounts, variations of funded accounts like IF Micro and so on and so forth. Well, it does not really matter if they are challenge accounts, but that is not the main point right now. Once again, let's look at the conditions. Overall, their trading conditions aren't bad at all. They're actually quite acceptable for both funded accounts and challenge accounts alike. And that's exactly what essentially attracted me the most in terms of buying their accounts. Besides that, I previously had quite a bit of professional experience in the markets, even before I started buying accounts from these prop firms myself. I had a client for whom I managed several accounts with instant funding. These were already funded accounts, and they held some quite decent and impressive balances. Every single time, they were very honest and straightforward about withdrawing the money. Once, as far as I remember, they trimmed the trades a bit because there were some minor violations. So that's normal practice. There's nothing wrong with that. So overall, they were consistently distributing payouts and paying out quite large sums of money, which again was a compelling and influential factor and a strong argument in favor of me deciding to purchase several accounts from Instant Funding. And here, as I successfully made profits on the accounts, I, as a matter of course, submitted my withdrawal requests. These are relatively minor accounts. I prefer to purchase these smaller balances and just oversee multiple accounts all at once. And I submitted withdrawal requests and the money was paid out. The only thing was that on one particular occasion, I actually had to wait for well over 2 weeks. And I never really received a clear answer as to why that was exactly, but nevertheless, that withdrawal was eventually made. And then one of my subsequent requests it completely shocked me. It was not so much the refusal to pay or the sudden account closure itself, but what really and truly shocked me were all of these, let's say, creative excuses the company started making up just to justify closing the account and refusing the payout. And by the way, while I was recording this video, I was actually able to close positions on one of my remaining instant funding accounts. All of these conditions were met. I've already submitted the request. As you can see, it's been submitted. Here's the time. It was literally just a couple of minutes ago. It's currently pending, and we'll have to wait and see if they decide to fulfill this specific request or not. But of course, we're not talking about the new request right now, but rather the previous one where all the, cringeworthy moments actually took place. What's the gist of the story? There were two trades, silver and gold. A new long position was recently opened for silver, and a protective stop-loss order was carefully set. You see, the stop was designed so that the total loss on the trade, in the event that the stop-loss was actually triggered, would be estimated to be somewhere in the region of $94 or $95. There was also a trade for gold. The situation here was quite similar. A specific sell order was executed and a stop loss was carefully set so that the potential loss, if that stop loss was triggered, wouldn't go beyond $84 and some change. And what actually happened in the end? Unfortunately, as you can see, the gold trade was closed by the stop loss, but with slippage, resulting in a very significant and noticeable slippage. In principle, the market is volatile, and there are no questions about that, as they say. It's a similar situation with silver. As you can clearly see, a specific trade was also unfortunately closed with slippage, and it actually surpassed the $100 mark. This resulting loss significantly exceeded 1% of the starting account balance. So the original starting account balance was exactly $10,000. And when I reached the minimum amount and satisfied all the required conditions and followed all the rules, so to speak, of the company, I then submitted a withdrawal request. And this is where, so to speak, interesting things started happening. So I was accused of having trades that violated the 1% rule. I'll show you right away what this rule is. Looking at the specific guidelines according to the rule, besides other things here, it clearly says that for any given trade you make, the total risk on that specific trade must not exceed 1% of your initial account balance. That is, it should not exceed $100. Looking here at these specific trading positions, we can see there was an excess, but it was directly caused by unforeseen broker slippage. This means the broker executed the stop losses at a different price level, and that slippage is precisely why this technical violation of the rule occurred. I, of course, formally submitted a detailed appeal, meticulously outlining and detailing the exact calculation of the stop losses I had set, where specifically for the silver trade we see that, according to the stop loss, my total loss should not have under any circumstances exceeded $94.50. And for the gold trade, it should not have exceeded $94.13. So by setting a stop loss order, I pre-calculated the maximum loss, the potential financial loss in case they were triggered, which would ensure that the total amount would not exceed the specified parameters. So there shouldn't have been any rule violation. And if these trades are closed at a stop loss with significant slippage, then in principle, it is not my fault. And in that regard, the decision to close the account and refuse the withdrawal was an entirely illegal and unlawful action. In response to my inquiry, I received an email, a truly fascinating and detailed email, which explained that the company's internal automated system, the one responsible for calculating risks and reacting to market shifts, focuses its logic solely on the specific distance between the initial entry price and the set stop-loss price, rather than taking into account the actual final execution price of the trade. And here they go back to the reasoning and explanation that, as they had previously explained before, my trades went significantly beyond the 1% threshold. So this 1% rule was automatically triggered, and consequently the account was deactivated and closed. Naturally, in response, I repeat the calculation and explain that, according to my calculations, this loss should not have exceeded $100. Moreover, in one specific trade, there was a significant margin. So, when you take into account the possibility of potential spread expansions and other variables, silver had a $5 buffer and gold had nearly 16. This provides more than enough room to cover any unforeseen factors or issues that might arise. In the next reply email, things just started getting ridiculous. I mean, they just give you these incredibly vague and hazy phrases like, our complex automated system accounts for super specific tick values and strict margin requirements and so on. This is the kind of opaque language which supposedly led to the alleged rule violation and ultimately resulted in the entire account being closed. So, what exactly are these highly specific and very special numerical values, or rather these tick values, and what are these margin settings? What exactly is the intended meaning behind all of that? Honestly, it's completely and utterly unclear to anyone looking at it. And once again, I am forced back to the fact that the company provides absolutely no detailed explanation or transparent, clear calculation. I keep asking them for clarity, and I've warned them repeatedly that this entire review will be posted on specific platforms in a public forum. So I'll be giving a negative review, but I'm giving them a chance to show and explain how all of this is actually calculated. Basically, what's the logic behind the violation they flagged me for? Even though, based on their own detailed explanation that it is only a violation if the threshold is exceeded, it makes no sense at all. And then the process just continued on. More vague, confusing phrases about how this is factored in there, but what exactly is being factored in, where is anyone's guess? I should also mention that in every single reply, they agree with my calculations, saying, yes, well done, you've calculated everything correctly. But despite that, some mysterious unknown factors supposedly kicked in, and the account was closed anyway. And after that, well, to be honest, I don't know. It all just seemed to hit rock bottom. Then in the next reply, I'm already told that the rule violation happened because of what? Yep, exactly. Because of slippage. Slippage, which the company previously claimed was absolutely not a factor in this situation. And then it's just a long-winded explanation telling me in great detail exactly how stop losses work, their specific triggering mechanism, and so on and so forth. Basically, it was just entirely unhelpful and pointless information that didn't address my concerns. So once again, I asked for a breakdown of what happened. Every single time I give them a fair chance to explain or show me something. And every time they come back with excuses like special parameters, complex price calculations, and so on, always some mysterious methodology. My friends, I ask you, what kind of hidden methodology or vague calculations can there possibly be when there is a clear and simple rule in place? They have a very specific and clear rule where it's clearly written down in their own, let's say, internal language. You simply cannot risk more than 1% on any single trade. That's it, nothing more. This rule doesn't specify any explicit or specific parameters, nor any clear ways to calculate or accurately predict the impact of slippage and so on. That is to say, in their various emails, they repeatedly and firmly denied the impact of slippage on the decision to close the account. Finally, when they saw that each of their lies directly contradicted the previous one, they decided to cite slippage after all. Well, let's briefly summarize everything we've seen. What is the essence of what was said? Well, you understand. I personally know from my experience that there are companies that were scams from the start. That is, no matter what you did or how you traded, they wouldn't let you withdraw, and eventually they closed down. There were quite a few of those. This, by the way, was one of the reasons why I even took a break at some point and didn't trade, because so much time and effort was spent on earning money, so to speak, and then not receiving it. When a company, which, like instant funding in this case, actually showed a lot of good promise and allowed withdrawals, meaning it worked fairly and honestly, eventually, however, an unfortunate situation arises where they suddenly begin to refuse all legitimate payouts and permanently shut down user accounts without warning. And the most important thing is that it's one thing if there are some hidden rules somewhere in fine print marked with 20 asterisks, which by the time you get to them, you'll be fed up with reading those rules. But here it's, well, let's call it what it is. Here it's blatant lying, where the company justifies the refusal of payout and account closure with blatant lies, where each lie contradicted the previous one. Some vague phrases, vague explanations, completely non-transparent, which are not reflected anywhere, not in any rules, nothing. And so here, well, all I want to say here is I don't have access to the company's accounting. I don't know if the company has financial problems or not, but this whole situation, it is a serious red flag. Therefore, if you are carefully thinking about buying an account from Instant Funding, weigh all the potential risks and all the advantages and disadvantages carefully.